Welcome to the Truth About Real Estate Investing show. And the truth is, I thought I built my investments by doing everything right. Started a side hustle in 2005, invest in hard assets by buying real estate in order to beat the stock market. That's using quotation marks, beat the stock market to ultimately get ahead in life. For 20 years, I tried. Together with my wife, Cherry, we built an 8-figure portfolio. And again, started in 2005, so it's been over 20 years. I've taught Canadians how to build real estate wealth through local residential real estate since 2010. I've been a 4-time Realtor of the Year to investors in Ontario, and for a long time, it worked incredibly well. And the market changed. I think everybody knows that. Interest rates rose quickly, prices corrected, immigration levels fell off a shelf. Some of my properties are down as much as 35%. Cash flow has dried up as affordability has gotten worse. Listings for income properties from motivated sellers, that means like power of sale, estate sales, have climbed to the highest levels I've ever seen in my career. That's the truth about real estate investing. Tenanted properties for the last 2 years or so began selling at a discount compared to regular properties, and they take significantly longer to sell. At the same time, investor buyer demand fell to the lowest levels I've ever seen in my 16-year career now. At the same time, the cost to add units, meaning like legal duplexes, has more than quadrupled since my first basement suite conversion in 2016. Back then, it cost just over $30,000. That's what I paid. And fast forward today, I see quotes regularly around 150, 160. To be clear, buying tenanted properties can still make sense in our local market for those who prefer local real estate. The discounts are real, and the reduced buyer competition can be a real advantage. But at the portfolio level, for many of my clients and myself, we're simply overweight local real estate. Concentration risk has increased, liquidity has declined, and the returns have become less predictable. On top of that, returns from my local illiquid real estate development projects were just cut by more than half. So losing money, I think we all know, is never enjoyable. But what became clear over time was that local real estate required increasing amounts of effort, risk, and personal involvement. I personally know many people, including my clients, who have let their property managers go because their cash flow can no longer support paying for professional property management. So yeah, there's less cash flow available. For our family, the trade-off between, so this is our own personal situation, the trade-off for my time and stress and returns was becoming less attractive, especially as I've come to learn about other passive alternatives. And then through introductions to Share in 2023 and Open Concept Financial Group in 2025, I was introduced to diversification strategies that align with our values. More passive cash flow, less operational risk, and stronger projected returns without abandoning. I'm not looking to abandon real estate altogether. We're still planning on holding several of our properties until the recovery. But I did expand my approach. I joined Share as head of business development in Canada. Cherry and I invested personally by purchasing a rental home in Texas through Share. I also joined Open Concept Financial Group as a wealth associate, and we're deploying 6 figures into our own private pension strategy. So professional money managers will be managing our money. Also, we'll be leveraging. Anyways, as always, we don't recommend anything to our clients that we don't already invest in ourselves. To be clear, real estate isn't going anywhere. We continue to coach and assist our local Ontario real estate investor clients. But Cherry and I have always wanted to do more than just help our clients buy properties. We've always wanted to help them plan for retirement and legacy as well. That's why we recently hired a financial planning associate to help our clients answer some of the most important questions they'll ever face. How much can I safely spend in retirement? How long will my money last? How much do I leave to the kids? And how do I minimize taxes on estate? That's also why we've expanded our services to include diversification beyond local real estate through U.S. investment opportunities, professionally managed stock and bond portfolios, and life insurance strategies for estate planning purposes. Our plan is to hold the remainder of our local income properties through the eventual recovery while rebalancing new capital into diversified passive strategies. So neither we nor our clients are dependent on a single market or a single approach, and also much improved liquidity. So I did what most investors are doing. I changed my portfolio mix when I learned something new, and the logic made sense. Today, I'm building a private pension plan I've always wanted for my family, with less landlord headaches or taking time away from my young kids. And that's what we talk about here on the show. And also this upcoming Saturday morning, January 31st at the Wealth Summit. Cherry and I will be sharing what's actually working now, so you can protect your time, your capital, and your future. We also have a guest speaker, author of the book Legacy, my friend Leslie Kinsey, and we will be doing a fireside chat Leslie has gone through some significant estate changes as she had to take over the family business and the family portfolio. And again, she wrote a book on the subject. We'll be having a fireside chat with Leslie Kinsey. There will be a link in the show notes to purchase tickets for Saturday morning, January 31st for the Wealth Summit. My wife, Cherry, will also be speakers. As I told you, the in-person seats sold out in the first week, so we do only have online seats available. Now, on to this week's show. Fixed or variable mortgage interest rates. Where are rates going? When to lock in rates? Commercial mortgages, what are the benefits and what are the latest on lending for multifamily properties, both resale and development? How developers are pivoting their CMHC MLI select strategies to maximize rents and cash flow. Why financing investment properties were infinitely easier in the USA, and what was before Donald Trump's announcement that the government is investing $200 billion to tank mortgage interest rates. Our guest today is Scott Dillingham. He's an old friend of mine, owner of mortgage brokerages in both USA and Canada, an investor specialist with a sizable real estate investment portfolio in Windsor, Ontario. I believe he has over 80 doors. He also has expansion plans for the USA in terms of real estate investing. Scott is a veteran of the industry, former #1 mortgage broker at one of the 4 big banks in Canada, and he can speak to residential, commercial, Canada, USA, and Mexican mortgages for Canadians. He's a one-stop shop for understanding financing, all the financing options a Canadian real estate investor, all the questions they may have, and all in this episode. So please have a happy new year, more happy health and wealth in 2026. So put on some headphones, go for a walk, or work out listening to this episode to prepare you for mortgage financing in 2026. I give you Scott Dillingham of Lend City, Canada and USA. Please enjoy the show. Hello, Scott. Welcome to the Truth About Real Estate Investing. What's keeping you busy these days?
Oh, man, Erwin, thank you so much for having me. Real estate, investors, mortgages, Canada, US. It's keeping me busy. Plus the kids, of course. Kids are always lots to do. Drive me here, drive me there, but life is good. I can't complain. What about you?
Speaking of family and stuff, do you do much? Do you cross the border very often for anything interesting? For the listeners' benefit, you live on a border town, Windsor, and I don't know if you see it yourself personally, but it's in the news all the time how travel across the border is like down significantly. Do you see anything? Has it changed your travel plans?
Yeah, like I think it's down because what they're doing, I'll give you a perfect example. So living in a border city, they have some really great malls right across the river. And my daughter likes to go and check out all the latest fashion stuff and whatever. And so the last time we went, we just bought a bunch of candy. That was really it, like candy, like $40 US of candy, but it was a bunch of stuff. Mm-hmm. And we tried to cross and they charged us duty on it because the tariff wars. We're like, what? You're charging us duty on candy? And they're like, yeah, well, we don't know where it was made. So we're just doing the flat, whatever. And I'm like, oh my goodness.
How much?
So I had to pay $20. More
than sales tax? 20?
I had to pay $20. Yeah, for $40 worth of candy. It was ridiculous.
I had no idea.
Because they didn't know the source of where it came from, so they charged me max duty. Right. And so I think things like that are happening a lot to people that, cross-border shop or whatever. Yeah. You do hear things in the news saying, oh, they're going to take all these photos of you at the border now. But they've actually been doing that forever.
Yeah, I just got from China, so this is whatever the Americans do to me will like compared to that.
Yeah, and honestly, they've been doing it forever. As you come in, you'll see all these flashes. They've been taking pictures of your cars for years. I know people personally that work there, like family, and they can see the whole inside of your vehicle, even when it's pitch black, with the current tech that they have. So when you hear people talk about it in the news, it's like it's old news. They've been doing this for years.
It's funny, just quick share. When I was crossing from China to Hong Kong in a car, they took each of our temperature as well.
Checking for COVID.
Temperature, they didn't say nothing. Just like, oh, just lower your windows. Zap. Like, they just use a gun and like, nope, they didn't ask permission, nothing. Didn't tell you what they're doing.
So what if let's just say one of your kids has a fever? What would they do? Would they not let the child out?
I don't want to know. I'm just thankful that wasn't us.
No kidding. That's crazy.
All right, anyways, let's jump into it. So selfishly, I have interest rate questions. I think
Yeah.
every Canadian has interest rate questions because it's a hot topic in the news. A lot of people, again, it's in the news a lot about people feel interest rates are high as well, and that's actually holding off people's buying investment decisions. Myself, selfishly, and a lot of people as well who have variable rate mortgages or mortgages coming up, they're not
Mhm.
exactly sure what to do either, or knowing where the rates are going to go. And the
Okay.
media, the banks, and even the banks are saying that we may see rates go up at some point this year. So many of us are trying to time the bottom as well for interest rates.
Yeah.
I just said a mouthful. You're the expert on this. What do you think, Scott?
Yeah. So I want to give you a bird's eye view over the last 3 years. Okay. Because I
Please.
think it all correlates. So at the end of COVID, there was a huge buying spree, right? COVID was still here, so it wasn't quite done, but people were buying because they were stuck in their homes and it was crazy. After that, the interest rates went up really high. So there was a bunch of pent up demand, even investors that we regularly speak to, and they're saying, we're going to wait. We want to wait till rates drop before we enter the market. So we have all these pre approvals that we've done, hundreds, I would say even maybe even thousands over the past couple years. And
Hang
we
on. You
touch
have
base
this
with
many
everybody.
buyers sitting on the sidelines?
Yeah, like Canada wide. We're very much like we're very broad. We have staff, all over. And so I am referring to the whole team. But the consensus for a lot of them has been we're waiting. We're waiting for rates to hit rock bottom. And so at the start of 2025, I thought that was the year. I thought, rates were coming down. It was going to like get back to kind of maybe pre-COVID, like not the rush during COVID, but get back to pre-COVID
Yeah.
levels.
I'm
Um,
with you on that. I thought the same. I don't think any of us
yeah,
expected tariffs.
that's right. And then tariffs added more to the delay because now there's uncertainty. People are thinking, oh, I might lose my job and all this stuff. So people are waiting. So what I'm trying to say is over the past few years, there's been lots of pent up demand that has not been released. So now we're at the point where the Fed, they did lower the rates multiple times last year. They're quite attractive. We're seeing
In the Bank of Canada.
variables.
In the Bank of Canada, not just the
Yep. Sorry.
Fed.
Yes. Yes. Um, and we're seeing in Canada as low as mid threes right now for some variable rate products, which is fantastic. Um, but now we're hearing, like you kind of said, that rates could potentially be going up. So I think we have a period here where the rates are going to stay low for a little bit. Like I don't think they're going to lower further. I feel like it is rock bottom. Um, and then the plan is to get them up a little bit. But you have to keep in mind that the lenders and everybody they're also in tune with demand, right? It's supply and demand. So if these pent up buyers all decide, hey, let's come out into the market, I think you could potentially see rates go up prematurely as an avenue for the banks and lenders to maximize their profits, right? Because that's what they want. They're profit based centers. So I can potentially see that or um, price increases, right? Because with as investors get out there, right, then those bidding wars start, and it's going to change from being potentially a buyer's market to potentially a seller's market. So you just want to be cautious of that. So I actually tell people like if you're interested in buying, I truly would buy now. Because you don't want to be part of that competition. You'll end up overpaying. And you also don't want to wait too long because they do want to raise the rates. We don't know how soon. And there's all these global, challenges and things going on that might delay them wanting to raise their rates because they're trying to keep it low for longer, maybe. But they're saying that they want to bring it up a little bit. And the banks, um, it's called, I think the website's called CMB or Canadian Mortgage Brokers magazine. If you look that up, you'll see there's a chart from all the major banks, and they're all predicting where the rates go. And they're all pretty much anticipating by the end of the year, rates go up. I believe it's like 25 basis points is the guesstimate. Now, again, like I said, economy issues and whatever, like all that stuff can delay that, slow it down, accelerate it as well. So you just don't know, but I do feel like we're pretty well at the bottom. I don't think it's going to go down. If it does go down, maybe a quarter of a basis points, so like 25 basis points, but we are hearing increases. So that's at high level. So I think you have a mixture of rates are at the bottom. People are comfortable with the tariffs now. Like it's not brand new news, right? They've seen the effect on the economy. And I can't speak fundamentally and say it hasn't been massive in a negative way, but I think people.
Well, you're in Windsor. I'm in Hamilton. Both
Yeah,
of our local labor markets have been hurt.
yeah, and it's definitely hurt, but you also see more and more investments, right? Boeing, I saw yesterday. I don't know if it came out yesterday, but I saw it yesterday where Boeing has agreed to build their aircrafts in Canada. They're skipping the states, right? They're there now. They're coming here. So, you're seeing shifts that way too. So it's pros and cons. We've got the pipelines that are getting approved now. So it's, we'll have to see. But anyways, I think it's a great buying opportunity now is what I would say.
Yeah, my crystal ball is as good as yours. So, I apologies. You probably get this question pretty much every day. So variable or fixed, or where does this conversation go?
Yeah, I think it depends on what you're buying, right? Are you buying your primary home? Are you buying a rental property? Because it's deeper than just the rate. So right now the variable rate is lower, which statistically, if you look at the past 25 years, so you can type in on Google fixed versus variable for the past 25 years, you'll see for 23 of the 25, variable was always cheaper, right? It was the past 2 years, maybe not 2025, but 23 and 24 where it was higher. So I think you have a couple of different people. You have those that want to play it safe, safe, safe. For those, I would just get the 5-year fixed. We are seeing some lenders come out with the 3-year specials. I don't like those because if we know rates are coming up and then the lender starts discounting a 3-year, they're doing that because they want you to get the 3-year. So you have to renew earlier and then you're renewing into a higher rate. Right. So I encourage, people to get the 5-year fixed in that case. But you've got those that
maybe can you share what you're seeing in terms of rates for the 3 and the 5 year then?
Yeah. So like owner occupied, we're seeing like 3.75s on the 3-year. 5-year fixed.
Tempting.
Yeah. And we got a couple of lenders at 3.99 for the 5-year fixed. This is early January. We're recording this. So depends when you hear this, of course. But so, there's not a huge spread between them, but I still think the 5 years is a better bet, especially if we know and the banks are predicting rates are going up at the end of the year, right? Why choose a shorter term in an environment where rates are going up? You want the shorter terms in the environments when rates are going down, not up. So I would do that. But then variable rate, I recommend variable for a couple of people, right? If this is a property that you want to sell, let's say, in the short term, and you might not replace the mortgage, like it could be a flip or something, or you just need something temporarily. The variable only has a 3-month interest penalty. So it's a very small penalty to break the loan, where the fixed, the penalty is much greater. Okay, so if it's a short-term play, I like the variable as opposed to a short-term fixed. Also, if you're somebody who, you make a killer income and you want to pay off your loan faster, the variable will allow you to do that because generally speaking, at most lenders, you can prepay 20% lump sum payments on the variable, or fixed, the lowest is 10%. And I see some at 15 and just the odd one at 20%, but most lenders are between the 10 to 15% annually you can pay on the fixed, right? So a couple different answers there, but I think either the 5-year fixed or the 5-year variable would be the two products I would select from. I wouldn't look at the other options right now.
So say today you choose the variable, or you're already in the variable. Can I choose the 5-year fixed later?
Yeah. Yes. So what happens is the lenders have a walk-in period. Generally speaking, you have to choose a lock-in period 3 years or more. So say you get the variable today and you hold it for 2 years. When you come up and decide, I want to lock this in, you have to choose a 3, 4, or 5-year fixed. So that's fine. Now, the problem is say you've had the variable and you held on for 4 years. Well, you still have to pick at least a 3-year term to lock in at, even though you would naturally have renewed in one. So, buyers that are really far into their term, that kind of sucks. But if you're in it, you just got in your term, then it doesn't matter. It's not an issue. Great
All right,
questions.
hey, I'm just like everybody else. I have mortgages. I've a lot of my portfolio is variable. I wish I was more fixed for the last few years, and I'm looking for the next opportunity to go fixed. So just naturally selfish questions, and that's why I invited you on.
Yeah, no worries. No worries.
Let's talk. Can we talk a bit about pre-construction, because it's in the news a lot now. Neither you or I have any of that, but I imagine some people are contacting you on financing options for something they bought pre-construction.
Yeah. Absolutely. I mean, GTA specifically, it's condos, right? That's what we're getting a lot of inquiries about for sure. Is that where you're going with this?
Yeah, you kind of tell me, because I don't get the calls for financing. What are people asking for? Does that come up a lot then? Pre-construction financing?
Um, it does, but it's not. There's a lot more resale transactions going on than pre-construction. So as a statistic, it's statistically less likely that somebody is buying, a pre-construction property, but it happens. So there's a couple benefits, right? If you're a pre-existing buyer and you're buying new construction, whether it's condo or a house, you can now get a 30-year amortization when you're using CMHC. So that's fantastic, right? Especially if budget's tight. So that's one of the things. But condos, I mean, that's where the challenge is at. Depending on your market, right? But we are seeing weak appraisals on certain condos, and there's not much you can do, right?
Right.
All the they bought 4 years ago at a certain price, and none of the building is selling at that. So we are seeing people have to increase their down payments to make those work.
Well,
It's kind of a
because
bummer.
on the other side, like, it's opportunity for some. I was literally talking to one of my colleagues at Rockstar, and he was telling me there's a really nice project. I think distillery. I think he said distillery, and they're selling like 900 square foot plus condos, like 2 bedroom, for like 700,000.
Yeah,
So that's oh boy, that's probably at least 40% off of what someone would have paid for that.
that's right. That's right. And some people, they don't have the extra money for the down payment. Like they just don't, right? So if you can come in and buy one of those at today's current market value, we know that the pricing corrected in Toronto, but if you look at all real estate as a whole, looking at a big chart over all the years, the gradual trend is that it goes up, right? So
Mhm.
even if
Mhm.
everything is down, like we have this platform, I don't want to promote it on here, but it sends our clients um, like what their home's worth, how much they pay down their mortgage, and it also shows interest savings opportunities if there is one. But it alerts you if there's problems with the report, and the alerts right now is like everyone's home is underwater. Like that's what the alert is the value of their property is less than their mortgage, and so it's happening everywhere, but some areas more than others. But again, when you're in those scenarios, it's a great buying opportunity, or it's one of those times where if you don't need to sell, just hang on, right? Like just hang on, um, given time, over time, and who knows how long, but given time, and it'll be back up. Like that's how it works with everything over time, whether it's gold or like it doesn't matter. It just all assets increase over time. So I don't know, just to share that, because obviously there's that sentiment going on that the home values. But again, it's a great time to buy. So it's a collateral thing, right? Like if you have a house to sell and then you're buying, your sale, you may not get as high of a price as you wanted, but your purchase, you're going to get at a cheaper price than you would have. So it's a trade-off.
No, I think we both agree it's a great buying opportunity for people who like whatever product. So let's stay with the condo example. So if market value is 700,000 for a 900 square foot 2 bedroom, is financing just regular then? Like, has anything changed?
No, it's regular. So like it depends if you're going conventional or insured, but the lenders are going to finance your purchase price or your appraisal, whatever's lower, right? So if these projects are selling at a discount and you can buy it for 7 and it appraises at 7, then it's just regular financing applies. So if you're buying this as a rental, 20% down. If you're moving into it, it would be 5% down on the first 500 and then 10% of the difference. So you'd end up paying 45 grand down for a $700,000 property. And then it's, just the regular rules apply. So, so that's all standard. It's just if you bought it for 900 and now it's worth 7, you have to come up that 200,000. Lenders won't finance that. So you have to give 200,000 out of your own pocket for that. And then your down payment and everything comes off of the 700. So it can be kind of expensive.
I'm kind of glad I stayed away from all this stuff.
Yeah. And I was so tempted too. I remember people and investors telling me, look, I bought this. I don't even close on it. I just assign it to someone before closing, make a couple $100,000. And like, that's what they were doing, right? Just buying as many condos on paper. They never closed them, but they assigned them. And like, that was their thing. But it's hopefully they didn't have a bunch of these contracts,
Even one is painful.
Yeah.
Because people are paying like $1,400 a square foot for these things. So 900 square feet, that'd be, 1 point something, 1.3-ish.
Yep.
And its market value today is like 700,000. That's ouch.
Yeah. It's hard for everybody, even the developers, right? Like, because they need the home to be sold for so much because they have a cost per square foot for construction. Obviously, there's profit in there too. But when you have buyers that are no longer qualifying and they can't, you know what I mean? Then they can't pay people. And that's why you see these projects collapsing and failing because there's just not enough money because it is what it is. So yeah, it's definitely a problem to watch out for. But it's a speculative. That's not the type of investing that I do. Like I don't invest into things that could go up. Do you know what I mean? I look for stuff that cash flows today. That way you don't necessarily have that problem.
Yeah, because even if the value does drop by 40%, if your cash flow, you can hang on to it and wait for a better day to sell it.
That's right. And I consider it like gambling. Yeah, I could go to the casino and I could double my money, but I could also lose. Do you know what I mean? So I try to do the investments where you're not hoping that it appreciates to make a profit.
And people forget, at least the casino, you can only lose your investment. Here we're talking about people who have lost beyond their investment. So
yes.
Let's move on to some more sunny topics. So it's 2020. It's January 2026. One of the big stories of 2025 was new construction development. So investors were developing and building properties using CMHC's MLI Select program. Now, now I've heard many things during last year. It was wonderful, and then it seemed like they were getting more CMHC was getting more restrictive. Also, at the same time, CMHC seemed to be getting more restrictive on resale apartment buildings as well. What have you seen? What are you seeing? Like, you're much closer to this than I am.
Yeah, I don't know that it's more restrictive in the sense that they have a debt coverage ratio that you have to meet, and that number stayed the same. But they did change some policies. So like people were getting townhouses approved through the program, but they were on separate lots, but they were adjoined. So CMHC stopped that. And then they also increased the CMHC fee in July. So we saw a huge abundance of applications coming in because people wanted to get in before the increase because it's a lot. Like it increased in some cases like between 2 to 4% higher as a fee, right? And think of that as like a lender fee or a
Oh
mortgage
boy.
broker fee. Do you know what I mean? Like we have clients that get mad at us because they have to pay a 1% broker fee, and sometimes depending on the lender. And
Right.
so the government of Canada is charging 2 to 4% higher in
Right.
some cases. So it's just massive. So
And some of
anyways,
these loans are million and up, so we're talking about like we're talking about increase of fees of 20,000 and up. We're starting at.
yeah, just to give you an idea. So, so there's lots of that going on. There still is lots of that going on. I think it's a fantastic program. Um, Places like Alberta, it's really good because you don't need to discount your rents to meet the program because the market rents in the area are actually deemed affordable because it's all based on the income in the area. So it's fantastic out there. But in Ontario, it's problematic because um, you have to hold back these rents for 10 years. And we were talking, previous to this, that there's certain municipalities that have their own requirement on affordable rents as well. So we both know a person, and ultimately combined with CMHC and the municipality, this client has to keep their rents affordable for those units. Like the other units is market rents, but for the affordable units, they have to keep it there for 30 years. So based on the city requiring 20 and the program requiring 10 on its own. So that's problematic because in Toronto and surrounding areas, I don't want to say Toronto, but all of Ontario, let's just say Ontario, we have rent control. And I know it's supposed to be excluded on new properties, but there's all this talk of the government waiving that, right? And getting rid of rent control. So if that happens and you give somebody a lower rent, so in Windsor, the affordable rents is roughly $880, right? Where the market rent of that unit would be $1,800 to $2,000 a month. So you have to take all that rent and you lose it, right? So what we're seeing investors do for new construction in Ontario is instead of having an affordable component, they're skipping that and they're making the building energy friendly and accessible. And that's qualifying them. So instead of getting, like normally with the MLI Select program, you can finance 95% of the construction costs, and you can get up to a 50-year amortization. So when we skip the affordable component, the amortization lowers from 50 to 45. Okay, so they're losing 5 years of max amortization, but they're getting market rents. So, I could do the calculation. It would be different per property, but I bet 9 times out of 10, your cash flow will be better by having market rents over 45 years than discounted rents over 50. So that's what the savvy builders that we work with are doing. Like we literally have some projects in spring and past projects they've done, and that was a strategy they used. So I think that is a really good play. A lot of investors don't do that, right? They hear the MLI Select program and they think right away they have to have affordable rents, but you can avoid that. And in certain places, I would, right? Like for Ontario, I would. I don't want to accept the lower rent. It's great that Alberta, the rents is the market rent, so you're not losing any money per month. But here, yeah, I'll waive my five years amortization to have market rents. So that's what I encourage if you want to get into the program. Obviously, resale properties, it's a little bit different because it's hard when you buy a resale building, right? If we're going to use the MLI Select program, we have to make that building energy friendly and accessible, right? If we want to get maximum points and leverage. So on a resale
That's not
building,
easy to do. To renovate existingly occupied
that's right.
property.
So usually just the standard CMHC program applies where they'll finance up to 85% and they'll give you up to a 40-year amortization. So we are seeing that, but so many people don't realize that this is even a program, right? Because most banks don't offer this, but when you go to a bank, they do it as a conventional loan. So you're getting a 25-year AM, 75% LTV. So you're leaving equity and cash flow on the table. So definitely look at the CMHC options. It's just maybe MLI Select may not be best for you. Maybe just a standard program. And just for your listeners to add extra value, this program works for, I've used it on student rentals. So it's called SRO, so single room occupancy. Okay, so anything like that we can do. It even works for like a nursing home as well. So we can tap into it. So it doesn't have to be just long-term rentals. Like this program is available for those niches as well.
When you mentioned student rentals, is that purpose-built student rentals, or is this like, take a house and chop it up and install 8 bedrooms?
Yeah, so I've only done it on purpose-built because they want it to be
zoned properly. Yeah.
Yeah, and five or more units. So within those units, right, multiple bedrooms, but they're still looking for 5 units or more to tap into CMHC. So if it is a single-family house that has 8 bedrooms, they're only going to consider it to be 1 unit. Do you know what I mean? Unless it's now, maybe if it was an ADU student rental and there's multiple things on the property, right, we could probably get away with it. But yeah, otherwise yeah. So for student rentals, it's been purpose built that I've personally done with this program.
Now, existing multifamily properties are still talked about regularly. Mike, I guess on the show, they still, a lot of people still like the multifamily investment asset class. How is the financing world in that market? I remember one of the stories from the 2025 and 2024 was like, for example, people were trying to do refis and they were telling me how slow it was.
Yeah, like I think it depends. There's two. If we're going conventional, which is an option, those are generally funding in 30 to 45 days, maybe 60 days, depending on how busy the lender is. If you're going with CMHC, honestly, I've been telling my clients like 4 months turnaround time for CMHC.
Oh boy.
Maybe faster, a little bit faster, right. But honestly, I'm going to say 4 months, like, because there's back and forth. They have questions. And
right.
So I'm going to say, it's 4 months with CMHC. And that's when they get.
And that matters because there's people, when someone's planning on when they're selling, they need to budget for that time.
That's right. So I think if you're tapping into CMHC, the whole process, I'm going to say is 6 months. Now, I know I said CMHC is only 4, but the lender needs their time to process the paperwork. And then once you get that final COI from CMHC, the certificate of insurance, the lender still needs a couple of weeks to process everything, create the paperwork, send it to your lawyer. Your lawyer needs time to do what they have to do. So yeah, CMHC is not fast. So what we do is if somebody wants to tap into CMHC, we'll essentially get a bridge loan or temporary financing. There's a deal I could explain to you guys right now where it's like, we have to do this to close on time. We have to get the client a bridge loan. And then CMHC will come in after the fact to, replace the bridge loan and go from there. Do you want to hear the story? Like, do you want me to tell you? It's crazy.
Sure.
Okay. Borrower buys this property, 16 units. We get the end of November, we get a document from the city saying it's only 15 units, but it had like a storage area that could be converted to another unit. But CMHC approved it as 16. That's what the offer to purchase said. And that's what the appraiser used for rent because they used rent for that unit. But the zoning is 15. So CMHC says, well, this is a material change. So we need you to redo the whole file again. They won't even update the numbers. And so that's months more. Now the borrower's closing date is the end of January, right? So we lined up, we had 2 options for the bridge loan. So we lined that up. But so he'll close on time with the bridge loan, then wait for the CMHC and then activate it. And the other thing too that we haven't discussed with CMHC is the rates are so much cheaper. It can be in the threes. Like we've seen like low to mid threes for apartment buildings, which is just crazy. Like it's cheaper than owner occupied financing.
It sounds like a good time to be buying used apartment buildings then.
I think so. And I think that's where you cash flow in Canada.
Before we were recording, you mentioned a lot of people are interested in commercial mortgages. I guess we've kind of covered some of that. Is there more to commercial mortgages than we've discussed?
Yeah. So the number one search term on our website, which I thought was weird because it's a US term. It's not even a Canadian term, but it goes to show me that people are looking for certain type of financing, but they're literally typing and searching into Google DSCR loans Canada. That is by far the number one search term for our site. So what that is, a DSCR loan is a loan that gets approved based on the property only and none of the borrower. So that is how CMHC does look at it, right? They're looking at, they call it the debt coverage ratio. So DCR as opposed to DSCR. And conventional commercials, the same type of thing. So there are, and we have helped clients that either don't have the income or they were maxed out, their debt ratios were maxed out at their current lender and they can only go with a B lender or a private lender. So by going commercial, we can do that even on a single family home. So there's misconception. People hear commercial and they think apartment building or retail plaza. You can do commercial loans on a single family property, but your loan size is going to be determined by the income, right? So if you're buying a $300,000 home that you can rent for $2,500, that thing will cash flow. It'll cover itself. You could get max leverage, right? But if you're buying $1 million home that only rents for $2,500, it's not going to cover the full size of the loan. So your loan to value will be reduced. So that's kind of the negative of this, where traditional real estate financing, even if the property didn't cover itself, they'd look at what your job, what you do for your job, and they'd use that income to offset any expense. But yeah, so that's what people are searching. So in Canada, investors are looking for those loans where they can qualify without any personal income. And we have a whole bunch of them. We've even locally on our team, like we have a guy who came over from a credit union. He was doing their commercial loans there for 10 years. He's recently come over and he's just doing them here with us, right? He wanted more options. So the team's growing in that avenue and the solutions are incredible. So it's something I would look at if you're facing any brick walls with your current lending.
You mentioned brick walls and you mentioned private lending and also B mortgages. Can you for the investor that's not familiar, can you explain what a B mortgage looks like and also what a private loan looks like?
Yeah.
So they know to avoid them.
Yeah, I'll try to I'm going to give you a couple things. I'll give you the debt ratios and I'll give you the rates and I'll give it to you guys in a way that's easy to understand. So an A lender on a rental property is going to be, let's call it low 4s to 5%. And I know we talked earlier, rates in the 3s, that was owner occupied. Those are cheaper. So your low 4s to 5s with an A lender, plus there's no fees. The thing with an A lender is generally speaking, they're only going to use half of the rent. Now there's exclusions and there are some lenders that we have that actually use 100%. But I'm going to say 9.5 out of 10 A lenders are only using half of your rent. And then they're using between 44 to 50% of your income to qualify. So if you make $1,000 a month, they're going to let us use $440 to $500 a month of that income towards debt payments. So your mortgage, right? Any other car loans, whatever. And again, we're using any rental income on top of that. So when we go to a B lender, so these are still regulated lenders, but they're not in most cases, they're not major banks. Sometimes they can be, like Laurentian Bank. They have a B lending side. So on B lenders, you can use up to, and this is still at 80% loan to value. They'll let you use more, but your loan to value has to come down. But at 80%, we can use up to 60% of your income towards debt ratios. So same scenario, you make $1,000 a month. Now we're using $600 to qualify you. So your purchasing power increases because now we're, instead of using $440 to $500 a month of income, we're using up to $600 a month. Now for rental income, the B lenders generally use more as well. So if it's a property you're qualifying for, they'll usually use 80% of the income. And if it's an existing property in your portfolio, they'll actually let us use up to 95% of the income. So it really helps you to qualify for more. Now, the problem with the B lenders, those rates start, I'm going to call it 4.8 to about 6.5. So rates go up, your approval amounts go up, but now there's fees as well, which generally range from 2 to 3%. I find some of the B lenders, they'll charge you a higher rate without a fee or whatever, but then the broker also usually charges a fee, like we do. And I don't know a broker that doesn't charge a fee on the B lenders, because it's not like the banks where they give you full compensation. It's a reduced compensation. So there's the broker fees, right? So you're looking at 2 to 3% fee. And then there's private lenders.
Sorry, Scott, just to explain that the lender fee is a percentage of the loan. So if it's a 1% lender fee on a $500,000 mortgage, the lender fee is $5,000 to the borrower.
That's right.
Right. Or
payable on
2%,
yeah,
payable on closing.
Yeah. So, and if anybody tries to get you to pay beforehand, run. Nobody should be charging any fees beforehand. And I hear of that happening a lot. Do not do it. It's against code of conduct that's supposed to be on closing. The last lenders are
private market.
Yes. So the last lenders are private lenders.
Yeah.
They don't look
so unregulated, wild west.
Yeah. They don't really look at the income. They don't even really look at the credit. Some do, some don't. They just want to know the story, right? How can your borrower pay the loan? And how can they get their money back, right? Like, how can they pay the monthly payments? And then when the year's done, or the 2 years is done, because it's usually from 1 to 2 years is the loan size, or loan length, I should say. How can they get their money back? So as long as there's a good story and it all makes sense, they'll generally do it. But private lending, those fees are much higher. So rate-wise, the cheapest that I've ever seen in today's rates is 5.99 it starts at. And they want a 3% fee. But I've seen all the way up to like 17.99. And I've seen fees go as high as 6 to 7% in total.
Yeah,
like
loan shark money.
Yeah. It's not cheap. Now, those higher ones, because it is risk-based pricing. So those higher priced ones, those are really troubled clients. Maybe it's somebody in a bankruptcy currently or in a proposal. And then this is going to like help them to pay that off. Like there's different things, but that's like, you're an extremely risky client. You'd have those high rates. I am saying 6 to 9 if your credit is like fair.
Right. Yeah, and we're seeing those high rates for, when someone's trying to buy 200 houses in Sudbury and flip them all, and put duplex, suite all the basements, and then
that's right,
rent them all out and do complete burrs. 200 properties at a time.
Yeah. Now for commercial, rates are similar. Like under these programs, rates are similar to residential. I'm seeing 4.5 to 5 on, say, like a duplex, let's say. But you do have fees, which I am seeing range from 1 to 2%. So there's still fees. Let's even call them the same as the B lenders, but the rates are like residential rates. There's no limits. You can buy unlimited. Where the B lenders, they'll max you out, right? You'll eventually get maxed out based on your income or how many you have, because usually they'll let you go up to 10 on the B lending side. Where commercial, it's sky's the limit. The one lender might cap you out and say, look, we've lent you $6 million. We don't want to lend you anymore. That's fine. We go to the next one, we continue. So it's easy.
Fantastic, Scott. Now let's pivot to the US because you're a special breed and that you can talk to all these subjects. Mortgages on commercial, development, apartment buildings, regular residential, B-Lend, and also you own a brokerage in the United States.
Yes.
What are we seeing in the US for people who are investing in the States? What are we seeing in the mortgage market for 2026?
Well, overall, rates have been coming down in the States. They're much higher than Canada. Rates in the States are even higher than B lenders here. Okay, so just to give you some context, because we just went over rates. But they're going to be coming down. Now, in the news, and I know we pulled it up beforehand, but President Trump announced $200 billion.
Yeah, not million, billion.
With a B. And he's authorized Freddie and Fannie, who's the equivalent of CMHC and Sagen here. He's authorized them, and there's the article. He's authorized them to buy bonds. So what that's going to do is it's going to lower the interest rates, right? Because the market is going to be flooded with additional money. So now it's going to be cheaper money. And that's going to bring up the housing market, which is, I think, fantastic because the US, just like Canada, right? Our housing market has the values of the prices have been going down. So when you own, you don't want it to go down. When you're buying, when it's, I need to buy a place, it's great when prices are low. But, as an investor, you want them to go up because it's an asset, right? So that's happening. Now that affects the owner-occupied stuff over there, but I know Trump is pushing from multiple angles, multiple credit agencies and just networks where he wants to get borrowing costs across the board slashed, not just owner-occupied mortgages. So I'm confident he's going to do it. I mean, everything he's said he's going to do so far, he's pushed forward. So
he's the world's worst poker player. He's telling us what his hand is, what his intentions are.
Yeah,
he's not hiding anything.
It's actually true. Someone did there's just an interview I watched, and they literally said that. They literally said if you look closely at Trump, when he talks about stuff off the cuff, you think it's just conversation and chit chat, but that's actually him not being able to keep his plans secret. Like he's literally telling you what he's doing. So it's interesting to see. But as an investor who's buying, it's exciting to know that their market is rebounding as well. So same thing we said about the Canadian market. Great time to buy over there because if you don't and you wait, you are going to end up paying more because the house pricing over there is going to go up. When the market's flooded with money like this and it becomes cheaper, buyers come out, right? And then that brings up the values. So get out there and
when
buy.
you combine that with, when I was brushing my teeth the other morning, I was having a conversation with Grok, compare the economic prospects for US versus Europe versus Canada. The US GDP is basically expected to grow twice the rate of Europe and twice the rate of Canada's. And then you combine government stimulus money to make real estate go up in price. It's hard to, I think it's worth, for anyone who's on the fence about looking into the States for investing, I don't know how many more signals you need to, how many more green lights on your drive do you need to see before you start looking a little bit further into investing in the States?
That's right. That's right. And it's one of those things, it's an option. And I even tell, because I was asked this the other day, actually. Somebody asked me, they said, well, does this hurt your Canadian business that you push and talk about the US a lot? And I was like, actually, no, like it's an option. So say you're wanting to invest here, but your market, to make it work, you just can't find cash flowing properties, right? Instead of giving up and not investing at all, right? The US, it's just an avenue. right? It's another resource because in the US, it's very easy to have cash flowing properties,
Mhm.
right? So, it may not be for everybody, but it's an option. Or same thing in Canada, like say, even if you're a realtor, right? Even if it's you, Erwin, and you have a customer and their income only supports $250,000 purchase, right? What are they going to buy here? Where instead they can use that, they could buy a couple properties in the States for the down payment that they need here. Do you know what I mean? So now they're
Mhm.
getting something where they couldn't before.
Yeah.
So
Yeah.
it's,
Or your real estate coach and your client wants to suite the basement for $160,000.
yeah,
They could probably buy a house or two in the States instead.
yeah. Yeah, so that's all it's about. It's about other options where maybe in your market where you invest or whatever, or your strategy, maybe that doesn't work here, but it could work there.
And not to put words in your mouth, Scott, but you literally said this about, I think, about 2 years ago. How many times easier is it to get the mortgage in the States than it is in Canada?
Well, I don't remember the exact number, but I want to say like infinite. Like it's just so easy.
Infinitely easier to get a mortgage in
Yeah.
the States.
Yeah, it's so easy. And there's a lot less red tape too. Like they do, I would say they're pretty much on par with Canada with fraud and money laundering, right? So they're looking at all that stuff, which I think is fantastic. But as far as documents and process and like, it's just so much easier. Yeah.
Now, Scott, you know I like single-family residential properties. You know, I'm a student and I'm a coach at Rockstar Real Estate. They're big fans of single-family homes. So I just just use single-family home as an example. I forget where I was going. Oh, actually, what I was going was also in the market that we're in today. The single-family residential house has proven to be a very resilient asset versus like for example in Ontario, if a property is rented, condo, house, duplex, whatever, they sell for a discount versus a regular single family home that doesn't have a tenant in it. So
Yeah.
I forget where I was going. Now, so for listeners who's hearing this for the first time, how do I get a mortgage as a Canadian? How do I get a mortgage on a starter investment property, which would be a single family home detached in the United States? How would I get a mortgage?
Yeah. So we start off, it's the exact opposite of Canada. And I think a lot of investors have a hard time understanding that or fathoming it because they're like, what's my next step? And it's like, well, there isn't one. There is, but it's not the same. So in Canada, as you know, you're supplying income, checking credit, all these documents, right?
Yeah.
It's a process. And then you
Yeah.
get a figure of how much you
Right.
qualify for.
Well, also, if you have a corporation like I am, or a lot of people buy with a corporation, then it's way
Yeah,
way more documentation that you need to ask me for.
that's right. That's right.
And
So
I feel sorry for you and your staff that you have to review it all and then try to
that's
make sense
okay.
of it.
We become, because we've done it so much, it's quite easy for us to make heads or tails. And there's actually some really great AI tools that are coming out.
Love
Want to
it.
check and make sure regulations are not against the use of them, but ultimately they sort and filter the documents, they rename them, organize them, and so I'm hoping that that gets green lighted because I think that'll make our life so much easier. But
Hmm.
so right in Canada, you have all these steps to take, and you feel like you've accomplished something, and now you know the value. In the States, it's like if the property covers itself and the loan size is above the minimum, because each lender has their own minimum loan size, you're approved.
Hmm.
Like it's that easy. So people are like, what? Like, what do I do? So what I advise every client to do is just to go find a house that you like, whether that's through a realtor or maybe you found one on realtor.com or Zillow, like whatever engine or share, right? Like wherever you find a property, give us the numbers. That's all. So we need purchase price, how much you can rent for. We need the property taxes and an estimate of the home insurance. Now, if this is in a gated community or whatever, or part of a condo corporation and there's a homeowners association fee, we need to know that fee too. And then we literally run a cash flow analysis and we say, okay, based on these numbers, the property qualifies for a loan up to X. So max is 75% loan to value for a foreign buyer. So you've got to have at least 25 down. But then when we run that through, we tell you exactly what the property qualifies for. Um, and if that works, right, if the investor is happy with those numbers, we give them a pre-approval letter, which they can give to their realtor. Um, and then use that along with their offer, because they have to submit that with their offer, and show that they're pre-approved. And then you got the house. Like it's like that easy. I mean, I'm oversimplifying a little bit, because then, yeah, you do have to fill out the lender's forms and show proof of down payment and stuff like that. But it's the house that approves you, not you as a client. And that's why the first step is literally find the house. It's not, you can buy up to X. It's find the house, and I'll tell you how much you can get for it. So it's just backwards, but it's easier once you get used to it.
And now, how many lenders can you shop that deal to in the States versus in Canada? Now, for the listeners' benefit, Scott owns mortgage brokerages in Canada and the US. So these are his companies. He knows this number.
Yeah. So, okay. So in Canada, there's probably a couple hundred lenders max. And I think last year, I have to forget because I don't write up our actual compliance, but I think last year we used like 60 lenders in Canada. So even though there's 300, some of it'll be, I'm including like credit unions and stuff that maybe are in areas that we didn't do deals, so we didn't use them.
Small regional players that are like, yeah.
So in the States, there's over 25,000 lenders. There's probably over 50,000 lenders. It's just the tools that we have access to over 25,000, which is just crazy. Like, it's crazy. And
how many of them want my non-resident business?
Well, I'd say half, at least half. Half are like, you got to be US. The other half don't care.
Right. So you have like 12,000 plus lenders who want non-resident, so non-American buyers.
Yeah.
Right. So there's more American companies that want my business than Canadian banks that want my business.
That's right. Now,
I'm a Canadian.
Yeah. The one question that I get asked all the time, though, is, well, what if I'm with a lender and they close down tomorrow, right? Because you hear of U.S. banks closing all the time in the news. And it doesn't matter over there. It does not matter.
Hey, all the time. When was the last time you heard of one? It's been a while since I heard of one.
Like, it's in the news. I guarantee if we Googled something, we could find a bank that closed in the past week or whatever. Not a major one. But the thing is it doesn't matter, because in the States, they all sell the debt. None of them, let me rephrase, not none of them. Very few are balance sheet lenders. So balance sheet means they keep the loan on the books. They all sell it off. Even Canadian banks that are in the States sell off their debt. TD, when they faced fines for fraud in the States, they sold their loans to Chase. Do you know what I mean? That's how they paid their fine, is they sold their mortgages. So even if a bank is going to close in the States, you have your FDIC coverage on your checking and your saving deposits, up to 100K. And then they just sell those loans to another lender. So there's never a problem. Like, they're not going to call the loan or whatever. It just gets sold on the third-party markets, and your mortgage statement is with one bank this year, and the next year it's with another bank. And that's all. So I just want to share that, give some confidence that it doesn't really matter.
Love it. Now, Scott, I want to push you on what you see under the covers with share clients. Because you mentioned earlier about, and you're looking for someone who's looking to buy in the States using realtor.com. A lot of people who are listening to the show are real estate investors. A lot of us are attracted to paying below market. Hence, we look for deals off market. Now, you've seen a lot of these deals from share clients. Any insights you can share?
I think I know where you're going with this, because I told you my findings. So I'm pretty sure that's what you're.
I know, but people need to know these things. This is the truth about real estate investing, right? Yeah. And no, like I said, who doesn't want to pay below market value? So I think we're doing a service to the listener.
Yeah. So there was. Our team has helped finance multiple share deals. I don't have a set count, but it's definitely been multiple. And I myself have been involved, let's just say half of them. Okay. I haven't done them all, because sometimes, everything's flawless and I'm not needed. But if I am needed or whatever, I look at the file. But the files that I looked at, So let's call them half of the multiples that we've done. The appraisal on every one that I saw was higher, and not by like a couple $100, by thousands. I think the one, man, I don't remember now, but I want to say it was close to 40 grand higher, like appraised value, than what Share, because essentially Share is a wholesaler, right? You guys will find off market properties, you renovate it, provide a turnkey solution to the investor. So the investor was able to pick up these properties from Share with a massive equity, standpoint built right into the deal. And I'm very positive it was like a 40 grand delta. So and it was like a home that was under 200,000, just to give an example. So there was a 20% equity position at least
On the
that
buy.
the investor,
Right.
on the buy.
So every investor wants these things. They want to make money on the buy.
Yeah.
So an investor to make a 20% equity gain on the buy, I think people would generally line up for.
Yeah. It's fantastic. Yeah. And then not only that, right, they are getting cash flow. They're being put into your system, because I know one of the requirements, and I think this is really cool, guys, because people don't talk about this. One of the requirements when we fund a loan with Share is we have to email the closing department what the terms of the loan were. So what the interest rate is, loan amount, everything. And the reason for that is because Share tracks this stuff. So if there's a refinancing opportunity because rates drastically lowered, Share will update you as the investor. And that's just so cool. Like, who does that? Banks are not going to do that. They want you locked in at those high rates.
Mhm.
So I like that you guys do that. Our program that I talked about earlier, that we use here in Canada, that kind of does the same thing. And it's fantastic just having that ability. So I love that you guys do that for your clients.
Yes. And also we send them back to you
Yes.
since you're a preferred partner on the lending side.
For sure.
Because you are that rare unicorn that does investments both in Canada and the USA. And you own those mortgage brokerages. You're not just partnering with somebody.
That's right.
I'm a cheap person. I think I've mentioned it many times on this show. I don't want to pay extra fees if I don't have to. So by you owning the brokerage, there's no added fees.
Yeah. I'm not partnering with someone and paying brokers. I know there have been some Canadian mortgage brokers that have done that, and then they advertise that they have US loans. But you're right. In those cases, it does become more expensive because you're paying like a third middleman for no reason, right? So it's direct market access with us.
Mm-hmm. Now, Scott, we're over time. Thank you for being so generous with your time. Where can people follow Lend City, get in reach with yourself or team members? Where do people go?
Yeah, I would just visit our website, lendcity.ca. When you go there, we have a resources tab, which has all of our stuff, our podcasts. It has our, strategy call. If you want to set up a call with someone on the team, we've got that. But we also have a ton of articles on there. I think we have over 100 right now. So anyways, there's all kinds of good stuff there. Check it out. Yeah. So investor resource tab. If you go up there, it shows you then, that's me. They could book a call. But yeah, right there. And if you click that, it opens up. It shows you everything step by step. We have a weekly investor email we send out too. If you want to join that, that's the weekly investor insight. So there's all the things, but all of our investor resources are right on this page that everyone's got up.
And you have your own podcast?
Yeah, we have two. We have one. So the Wisdom Lifestyle Money Show that you have there, that's for investors.
The Win Show. I like it.
The Win, yes. Yes. And then the one below that is called Close More Deals. So I've been educating realtors for years. Like locally in Windsor, there's a large group of realtors that every Wednesday I would train and go over these different programs. And I help them to close all these extra deals. So I decided to call this one Close More Deal Podcast. And then I just talk about a special program every single week, right? So if you're a realtor, doesn't matter if you're Canada-wide or whatever, but we have special programs in there for you to learn about for your clients. So yeah, super cool stuff.
All right. Fantastic. Thanks, Scott. Thanks so much for doing this. I didn't know we'd take the full hour, but we had a lot to discuss.
It was funny. You're like, yeah, we're going to make this one quick today. We're going to do it. And yeah.
I
There we
do
are.
believe you hold the record of being on the show the most times. So
Well,
I
I
don't know how many
appreciate
times we
that.
could talk about your journey.
I appreciate that. No, I really do. We just want to be that unique thing for the investor, right? We're not a transaction based. We're here to help. We're here to coach, and we just don't want to tell a client no. So that's why we have experts in all these different categories. Like it's not me. If you want development deals, we partner you up with developers, right? You want student rentals, we got a student rental expert. You want US, we got US experts. So we try to do that so no matter where you are in your investor journey, you can be taken care of.
Right.
So
And I can just
yeah.
have one podcast guest on instead of having three.
I appreciate that.
Which is why you get to be on the show so many times because we cover so many subjects.
That's awesome. Well, thank you, Erwin. I really appreciate it.
All right. Thank you again for doing this, Scott.
No problem. Take care.
All right, friends, that wraps up another episode of the Truth About Real Estate Investing show for Canadians. Hope you got as much out of this one as I did. Remember that whether you're just starting out or a seasoned investor, there's always something new to learn, and it's always about building that practical knowledge base that gets you closer to financial freedom. If you found value today, please do us a favor and leave us a review or a rating, share this episode with a friend, or better yet, join our community of real estate investors who are taking action and making moves. And hey, if there's a topic you want us to cover or there's a certain guest you'd like us to have on the show, drop me a line. My DMs are open on social media. Reply to this email that this has arrived on. I'm not hard to find. We're all about getting you the unfiltered truth to help you on your journey. Thanks again for tuning in, and we'll see you in the next episode. Until then, stay smart, stay curious, and keep building that future. Catch you later.